welcome to Focus on Finance. I'm your host, Melanie Parker. Focus on Finance is brought to you by the Consumer Education Division of the Right Legacy Group. Speaking of the Right Legacy Group, we have the managing member here today, Mr. William Steve Wright. Welcome, Steve. Glad to have you.
Yeah, good to have you on this good, chilly winter afternoon.
Yes, we've had quite a few of those, definitely. So I can't believe it. It's a blur. We just put up our Christmas tree at the office. I think I just took that down a couple months ago. But 2018 is coming to an end.
Coming to an end, and in the area of finances and taxes, there are several items, action plans we like to call them, that you need to pay attention to.
Right.
In order to save your money, make your money, and meet some critical tax deadlines.
Yes, and tax that necessary evil.
Yes, it is.
Yeah.
And there's some regulations you have to pay attention to, but I thought it'd be a good idea to run through a list of some items that some things absolutely need to be done by the end of December.
Good.
Which, if you don't do some of them, may cause you some tax penalties.
Oh, ooh, yeah, penalty's not a good word either. So checklist is always great. Mm-hmm. All right, well, let's start at the top.
Okay, kind of action plan. Basically, if you have turned 70 and a half this year, or you're over age 70 and a half, and you have money in an IRA, a 401k, nonprofits, or 403b, thrift savings plan for government employees, you have to take out what's called a required minimum distribution.
Right.
There's a table that is used to calculate how much you have to take out. Mm-hmm. In general terms, the first year you turn 70 and a half, you have to take about 3.65% of the balance of your account as of last year, 12/31/17. Mm-hmm. The government had an agreement when you put money into your 401k, your IRAs and things like that, you got a tax break on the seed, but now that its seed has grown and you got this harvest of money, you have to pay tax on not only what you put in, but the growth. Mm-hmm. And so the government has not participated in any of this money yet. Mm. So they require you to take out a certain percentage each year once you turn 70 and a half and later.
Okay.
That has to be, for 2018, has to be done, left your account by the end of the year.
Okay.
Now, in all honesty, please don't wait till December 29th or 30th. It won't happen. Mm. If you fail to take the money out, let's say you're supposed to take out $5,000, there's a 50% penalty for not taking it out.
Oh my.
So you have to take out the $5,000 plus another $2,500, pay tax on $7,500, give the $2,500 as a penalty to Uncle Sam, and it's just bad news.
Oh, that would hurt my feelings. Yeah.
So it's very important that if you have not taken your required minimum, to get on it right away.
Right.
And calculate out. And remember, if you have, say, 4 different IRA accounts, you got to add up the value of all 4 and get a number, and then you have to make sure that you take out the correct percentage from this number. You can take it all out one, or you can take one out a little bits of each. So,
yeah.
But you got to make sure you get it done.
Right.
It's a major issue as you get towards the end of the year.
Yeah, and you don't want to wait till the last week of the year.
No.
Your financial advisor is going to be bogged down. And
or
it's the
vacation,
holidays.
Or on vacation,
yeah.
skiing somewhere.
Exactly. It's the holidays. How long normally does that process take? Just to give folks a heads up, an idea.
It could be a 7-day process sometimes,
okay.
4 to 7 days. It's just,
wow.
It's just quite simply, as a practice, we usually schedule the last ones that we have for our clients no later than December 10th.
Smart.
Which gives us 20 days to make sure everything gets taken care of.
Right.
Because we don't like paying unnecessary penalties and taxes.
Of course not.
Yeah.
Yeah.
And on the subjects of the required minimum distributions, there's another real neat tax code called Qualified Charitable Distributions. Now, what it does is that it allows you to, the required minimum distribution you have to take from your IRA accounts, if you send that money directly to your church or charity that you're giving to anyway,
right.
and have it sent directly to them, then that takes care of the required amount you have to withdraw from that account. But if you send it directly to the charity, you don't have to pay tax on that as income.
Okay.
So
wow.
If you're normally giving $5,000 a year to your church or your charity, and your required minimum distribution, let's say, is $7,500. Well, if you withdraw the $7,500 and put it into your bank account, you're going to pay tax on all $7,500.
Right.
But if you instruct your IRA custodian to send $5,000 of that directly to your church, and you get $2,500 into your bank account, you only pay tax on the $2,500.
Gotcha.
So it's a real good thing. Qualified charitable distributions, and again, those take time. I mean, 7 to 10 days to get the transfer. So really no later than December 10th, you really need to get that process going to make that happen.
Right.
But that's a beautiful way to take care of your charitable giving, satisfy the required amount you have to take out from your IRA accounts, and keep Uncle Sam happy and lower your taxes.
Everybody wins. Now that for your example, the $5,000 that went to the church, would that be a tax deduction on your taxes?
No, good question.
Okay.
If you do it directly from your IRA to the church, it doesn't count as income.
Okay.
But you do not get to count it also as a charitable deduction.
Gotcha. So it's a
It'd be
win-win,
double.
not a win-win-win.
Right.
Gotcha. Okay.
We're good there, yes.
Okay,
Yeah.
good.
A third thing is many people, we're told that, if you have money into your IRAs, 401ks, and things like that, that if you take money out before age 59 and a half, there's a 10% early withdrawal penalty.
Okay.
The penalty is there designed to make sure you put the money away for that later in life, once you turn 59 and a half. However, there's a little known tax code called 72T, 72 and then parentheses T for Tom, tax, whatever. And under this tax code, it provides a way for you to take money out of your IRA account before age 59 and a half and avoid the early 10% penalty.
Wow.
All right. But the way it works, there's a calculation that we do that designates to the penny how much you can take out each month. If you miss that by 1 penny, technically, you have messed up the whole system, and you're going to pay tax on all that money and a penalty and things like that.
Wow.
So December is a good time to add up and make sure you got to the penny.
So don't try this at home, folks.
No. It's a good time to add up
Yeah.
and make sure you're getting the correct amount for the year, because if you get out 1 penny more, 1 penny less, technically you're in violation of this 72T arrangement stuff.
It's like walking a landmine.
Well, but once they're set up, they're all 99.9% auto payments set up, but things happen.
Sure.
So you got to double check that.
Sure,
So that's the
sure.
third thing. Again, you would have a big penalty and stuff like that if that happened.
Okay.
So we're kind of football season here. We're talking about penalties. But
Yeah.
we're good.
Yeah, no penalties, please.
The other thing, the fourth item really is life happens. People get divorced. They get remarried. They have birth of children. They apparently, unfortunately, have children pass away and things of that nature.
Oh, yeah.
One of the tragic mistakes that people make is that as life changes, they do not check and change the beneficiaries on their accounts.
Yeah.
The court system is full of cases where someone was married, they got a divorce, remarried, opened up a new IRA account and started working with a different company. He passed away. He never changed his beneficiary, and his previous first wife gets all the money when the second wife thought she was getting
Speaking
it.
for women, I would not be happy.
And the Supreme
And the other way around, too.
and the
Yeah.
Supreme Court,
Right.
in many 9-0 decisions, which are really rare, have determined the name on the beneficiary form is who it goes to.
It's what holds water, yeah.
Okay, so
Yikes.
it is very important that your life's work, money you've saved and things, that it goes to the people you want it to go to.
Yeah, that's a
I
big
mean,
deal.
Just quite simply to go to
Sure.
you want to go to, because court fights can cost more money than the money you may receive as an inheritance. So it's a good time, and it's really not a bad time as you're having family get-togethers and gatherings. If it's appropriate at this time to remind children, grandchildren, nieces, nephews, whatever, this is some accounts I have. These are this is where my beneficiaries are.
Right.
I just want to let you know. And it's rare, but sometimes say, I don't want the money, give it to my kids, your grandkids,
Sure.
which is great.
Yeah.
So as a grandparent, I would want to know that my money is going to who they want to go to.
Right. It's just a grown-up conversation that needs to be had.
Right. And
you know.
particularly, we've been blessed with 5 grandkids over the past 4.5 years. We got to keep naming names on our beneficiary forms.
Yeah, you have to
time
update
one-
every year, don't you?
So anyway, that's on my
Yeah.
mind because it can be very tragic that money goes to the wrong person.
Right.
That you don't want it to go
Right.
to.
And I'm sure once in a great blue moon, the ex-wife might maybe say, you know what, it was a mistake on a form. Here you go. I was with him for 5 years. You've been with him for 25. It could happen, but why take that chance?
It may not happen.
Right.
I don't
It
know.
could happen,
But
yeah.
The court system is full of cases
Yeah.
challenging who the beneficiary
Right.
was named on the official
The law
form.
is the law.
And then here's another thing, though. If you've been with a firm, a financial firm, or even a company that has been bought and sold and changed, these forms get lost.
Yikes, yeah.
I mean, if you did a beneficiary form 20 years ago, you better update it. I mean, there could be no clue. And then if there's no beneficiary named, it can go into your estate. It's just a big mess.
Sure.
And everything. So even though you say, oh, I took care of that, Steve, 15, 20 years ago.
You know, maybe as a rule of thumb, when you're drilling down into your tax paperwork every year, that might be a good time to look through things and make sure that, because like you said, life happens, things change, things ebb and flow, and
And then the fifth thing is there's a thing called Roth conversions. Remember, we talked about money that you put into IRA accounts and stuff. You get a tax deduction on the seed, and then it all grows taxable, 100% taxable when it comes out. Roth IRAs are the reverse. Money that you put in, you already pay tax on the seed, so that the growth and all the money that comes out later is tax-free. Well, each year you have the ability to take part of your IRA money and convert it to a Roth, to go from 100% taxable to 100% tax-free. However, the secret is knowing how many dollars to go from here to here without causing you to bump them to a higher tax bracket.
Wow.
And so you should get with your tax person or your financial person and have them kind of estimate your 2018 taxes. And if you got room in your tax bracket where you can take $4,000, $5,000, $6,000 and move it from here taxable to tax-free, then it might be a good year to move a little bit of money. So you just pay tax on maybe this small amount there.
Strategic.
Yeah. But Roth conversion, again, it's one of those things that have to be completed. The money has to go from the IRA to the Roth by the end of the year.
Right.
You know, so.
Yeah, so the office manager at the Right Legacy Group doesn't want to call on December 20th wanting to do that. She'll do everything she can to help, but that would be tough.
So I'll get you the paperwork. We'll see how it works off. Okay.
Yeah. Sooner the better. Sooner the better.
Another thing, maybe number 6 here, is it's a good time to check how much money you have put into your 401k. Particularly if you're a company match, you definitely want to put in at least enough to get the full match, company match. And put in a little more if you can. But anyway, you want to check how much has been added. You probably have gotten at least 11 months worth of payroll stubs. Kind of calculate out how much will be taken out in December and make sure you're getting the match. What I really would like to challenge everyone to do is, as 2019 rolls around, to increase their personal contribution by 1%. You may be putting in 4, bump that up to 5, you really won't miss the money that much.
Right.
And with the new tax code, you're keeping more money in your paychecks anyway. So just put it into your future 401k plan.
Right.
So,
yeah, I was a couple weeks ago, you did a talk about just that to a local bank with 100 employees attending and talking about the importance of taking advantage of the match. And if you get a raise, if you've lived this long without it, let it ride.
Yeah.
Just let it roll
Put
right
the
in that
raise-
401k. It was good information.
Yeah, absolutely. And also, if you're under age 70 and a half, obviously you can't do the qualified charitable distribution by sending money directly to your charity. But it's a good time of year to make sure, if you're going to donate to churches, charities, things like that, to make sure you get those in by the end of the year. If you do the itemized Schedule A on your taxes, that church has to have receipt of that money by 12/31.
Gotcha.
And I know several churches here in town that will be open till 1 or 2 o'clock that day.
I bet.
Someone will be at the church
Sure.
in order to get the money and get to the bank as of the end of the day.
There's a run on the church with checks in hand. What a beautiful thing on December 31st.
But it just beat it. And December is one of the largest months for charitable giving in America anyway.
For a lot of reasons.
For a lot of reasons. People
right.
will wait and wait to take it out of their account at the end of the year. They realize they got some charitable causes. This country runs on charitable giving and very volunteer-oriented individuals.
Yes. Hardin County is known and is phenomenal about their charitable giving and volunteerism and all of that. Great place to live.
Yeah. Let's see here. There's a couple other things we need to touch on there. It gets a little technical, but if say your mom died and there's you and 2 other siblings, and she died this year or stuff, by the end of the year, if you're going to each inherit 1/3 of that IRA account, it's really best that by the end of the year, you have each individual account set up and the money is split 3 ways.
Gotcha.
The reason for that is if you inherit money as an IRA from a parent, you can take the money out. There's a required minimum distribution you have to take out, even though you may be 30, 40, 50 years old, not 7.5. But if you separate out the money into your own individual account, then each of you all can use your life expectancy, your age, to determine how much money comes out each year.
Oh, okay.
If you don't, then you have to use the age of the oldest person, and if you're the youngest one, say 10 years younger, you're having to take out more money than you would have to normally.
Gotcha.
So there's a basic rule of thumb. If you have inherited an IRA, by the end of the year, it's a good time to make sure you have the accounts separate and the money is split out and everything. Again, it's a tax savings for each of you individually.
Gotcha.
From there now. So it gets a little technical, but that's just a broad
Right.
picture of what needs to be done.
There's
there.
a lot of loopholes, but something I've found that the Right Legacy Group is good at, and the tax folks that we work with, is finding those loopholes, those legal loopholes, to help you keep your pennies in your pocket when at all possible.
I told a lady today at the office, said, do you know what the difference is between legal tax avoidance
Right.
versus tax evasion?
What?
It's about 12, 15 years.
That's good advice.
So
Yeah.
we like the legal tax
Yeah.
avoidance,
Sure.
well within the confines of the tax law. Tax evasion will make us all cellmates for a long time.
Oh, yeah.
We don't want that.
No, we
from
don't.
there.
Tight quarters, no. No. Well, and it's a tightrope.
No,
It's
it
taxes.
is.
It's a tightrope. And I don't have a lot of property or anything like that, but I'm getting to the point where I will feel more comfortable having a professional do my taxes.
Yeah.
You just don't know what you don't know.
Right. That's
Yeah.
what gets people in trouble, is what they don't know and assume that this makes common sense, but according to our tax code, it's not allowed, or it doesn't make common
Right.
sense.
And I don't know that the IRS really uses "I didn't know" as an excuse very often if you get audited.
I don't think that's on their list of exemptions
No.
on things like that.
No.
Yeah. Another thing, as we've been talking about IRAs and things like that, you need to check. A couple of years ago, the IRS passed a regulation that said that if you only get to do an IRA rollover once every 12 months. And what I mean by this term here is, if you were to call up this company A, we have money, and say, send me a check for $10,000. Well, you have 60 days to put that $10,000 into another IRA account, or that $10,000 is deemed to be taxable income to you. All right? Now, before, you could call that company in January and say, give me $10,000, and within 60 days you could put it into your new account here. In March, you could tell them to give you $5,000, and you could put it into a new account there. When you receipt of the money, that any number of those were allowed till a couple of years ago. Now you can only do one IRA rollover where you receive the money payable to you every 12 months.
Wow.
Not
Okay.
calendar year, but if I took $10,000 out of this account here on September 1st of 2018, I cannot receive the money personally and do a 60-day rollover until September 2nd of 2019.
Wow, that clock starts ticking right then.
So it's from the date, it's every 12 months, not a calendar year. That's why we prefer, as people are moving money from IRA to IRA and stuff, you do what's called a trustee to trustee transfer, where that company sends it from company to company. Much like we talked earlier about having your IRA go from IRA directly to the church.
Right.
The money can't come into your hands there.
Okay.
So if you've done a couple and you're not sure, was that check payable to me or was it payable to the new company, it's time to check those.
Yeah.
And if an error has happened, hopefully it's within 60 days so that you can correct it.
Gotcha.
And all there.
So around tax time, and we're looking at our taxes, we're looking at all our finances, beneficiaries, and all of that. Is that a good time, if you have a 401k with your employer, is that a good time to sit down with that representative and say, hey, when is a good time to do that? Let me look at what my investments are and what do I need to move anything or do anything?
Yeah, most companies that have 401k plans, the custodian that runs the plan, a lot of them do it throughout the year, quite honestly.
Good.
Most of them will have a personal representative coming in every so often, but most of them are now set up where you can call in practically 24/7.
Well, that's nice.
And talk to someone on the phone
to
answer questions. But you have to understand, when you're dealing with a large company 401k plan, you're talking to someone that can tell you facts, but not to advise you on what to do.
Planning.
So you may have a list of investments this long, and you've chosen 3 of those.
Right.
And if you ask, well, what else should I invest in? They can describe what those investments are, but they can't tell you which ones to choose or not choose.
Right.
So that's kind of how that
Yes,
works.
and I've always, I've worked at the Right Legacy Group for 10 years, and I've always loved your open door policy, because there's been many times I've brought you a list and said, okay, what do I do? And that's nice. And that open door policy actually extends to the community,
Right.
to our families, our friends, our clients, our neighbors. And that's just something that the Right Legacy Group does. And I'm sure there's other financial advisors do as well.
Oh, absolutely, yeah. On the subject where we're telling you to make sure you check the beneficiaries on your forms,
Right.
it's also a good time, as you're having family gatherings and things, to double check who you put down to be the executors of your will.
Yeah.
If you have a trust set up, you double check the successor trustees, make sure that's still the individuals you want.
Yeah.
If you have financial power of attorneys, healthcare power of attorneys,
Big deal.
double check to make sure the people named are the ones that you want to be named to make financial
Right.
decisions for you.
And that they know and everyone else knows as well.
Everybody knows.
Yes, have that conversation now. That affects families.
Right. For
Yeah.
financial matters, daughter A is going to take care of that.
Right.
But however, son, you got a medical degree. You're a doctor.
Right.
You can help make medical decisions
Yes,
if I can't
yes.
make it for myself.
I've seen. I came from the medical world, working at HMH, to the financial world, and I've seen on both aspects, the greatest gift a person can give their loved ones is being prepared. Having everything, health, financial, everything already laid out, because even the closest of families can really be hurt.
Oh, and permanent divisions among
Yes.
siblings
Yes.
because of a quick decision that had to be made or a delayed decision
Right.
where someone is in life support situation like that,
Yes.
where no one was clearly named to make that decision for mom or
Right.
dad.
Exactly.
It's tough. And these are all things, as you mentioned, it's a gift to your family to have
It
this
is.
stuff in order.
It is.
And to make it work there and all for them. All right, then another couple things. We mentioned about IRA contributions, things of that nature. Technically, you have till April 15th of next year to put money into your IRA account back to 2018.
Oh.
All right?
Okay.
However, that's what everybody does.
Oh, okay.
However,
Yeah.
if you've already made your 2018 contribution, if you're under age 50, you can put in up to $5,500 a year. If you're over age 50, you get to put in an extra $1,000. Well, why not go ahead and make your 2019 contribution in January
Oh.
of this next year?
Just get
That
it
way,
done.
You have a whole year's worth of growth ahead. Instead of funding it backwards,
Sure.
12, 13, 14 months.
Pay it forward.
Pay it forward, do it in January so
Yeah.
that the money can grow for you a whole extra year
Smart.
or more. You know, so it's just one of
Makes
those little
sense.
tricks there.
Yeah, those little
If you
tweaks,
know
yeah.
you're going to contribute, you know the dollar amount limit on that, go ahead and get it taken care of, and that money will have a whole
Yeah.
extra growth.
Proactive.
Oh, that's what we like,
That's
to
a
be
big
very
word.
proactive
Absolutely.
and all there. So
Well, Steve, we're out of time.
we're out of time.
We are out of time. I am so sorry. We're going to have to do this again very soon because there's so much. There's so much. Just preparedness and checklists and talking to professionals and not assuming that everything's taken care of, but really being on top of that.
And as we're in December, your advisors and particularly your tax accountants and CPAs are not as crunched as they will be first, second week coming in January.
Right.
So this
Right.
is a good time to schedule a little time, take care of some things, and go over these
Yep,
items.
spread it out and take a look
Right.
at it. Thank you so much.
All right.
Appreciate your time, Steve.
Sure.
Your knowledge is here, but you're very good about talking down here for me, and I really, really appreciate that. And I'm sure everyone else is as well, because you explain things greatly. I'm Melanie Parker. Thank you to Steve Wright for joining us, and we'll see you in 2019.
I consider it an honor to be able to work with my father. It's always a unique experience, not only having been raised by him, but now working alongside of him. I get to see how consistent he is. The principles that he raised me with, I get to see him work out every day and live out in the way that he works with clients, as well as the way that he leads the business.
3 decades ago, I went on my own shingle. When you do that, you're taking a lot of risk. That's what entrepreneurs do. But I came to a point in life that I got tired of trying to live by other people's rules. There's a higher standard of the rules that I want to live by and raise my family by.
I saw the way that he was able to just build relationships with those that he was working with. You could just tell that what he was doing made a difference. And that's something that I wanted to be a part of.
The word legacy is a word that's been around a long time. Legato, I think, is where it actually, the root of the word there. The Bible says that a wise man leaves a legacy, an inheritance to his children's children. So in our planning, we are trying to make sure that people are not only living and take care of their needs of their family today, but are creating a long-lasting effect so their children and their grandchildren can have a better life and a better future. The Right Legacy Group is a combination of advisors that can provide individualized, tailored plans to families, teenagers, the millennials, the Gen Xers, Gen Yers, and the seniors that we love so much.
A legacy is how you're remembered. A legacy is who people see you are and what your values are. It's not just monetary, it's about who you are and what defines you.